Do you want to invest, but the stock market seems complicated? You've probably heard terms like ETF and mutual fund thrown around, maybe on the news, or in your 401 paperwork, and thought, what the heck are these things? You're not alone. Most beginners feel confused at first, but the good news? These are actually two of the easiest and safest ways to get started with investing. If you understand how they work, in this video, we're going to break it all down. What ETFs and mutual funds are, how they're different, what they cost, how they perform, and how you can choose the right one based on your financial goals. Whether you're saving for retirement, trying to grow your money long-term, or just learning how the stock market works, this is the foundation you need to get started. Let's go. Let's define the basics. An ETF, or exchange-traded fund, and a mutual fund are both what we call pooled investment vehicles. That means they take money from lots of investors, thousands, sometimes millions, and use that money to invest in a bundle of assets like stocks, bonds, or commodities. So instead of buying one company's stock, you're buying a slice of many companies all at once. It's like ordering a smoothie instead of just an apple. More flavors, more nutrients, less risk. That's called diversification, and it's one of the smartest things you can do as an investor. Both ETFs and mutual funds are professionally managed, either actively or passively, and both aim to grow your investment over time. But they go about it in different ways, and that is what we'll explore next. A mutual fund is typically actively managed. It means there's a fund manager, or sometimes a team who is handpicking which investments go into the fund. Their job is to research companies, analyze market trends, and try to pick winners that will beat the market. For example, a mutual fund might invest heavily in growing technology stocks, or safe dividend-paying blue chips. Some mutual funds are more conservative, like bond funds. Others are aggressive, like small-cap growth funds. You can't buy mutual funds like stocks. You buy them through a brokerage or retirement account. They're priced once per day, based on something called NAV, or net asset value. You won't know the exact price you're paying until after the market closes. Mutual funds are commonly found in retirement plans like 401s and IRAs. They're a favorite for long-term investors who want to trade every day and prefer a more hands-off approach. An ETF, or exchange-traded fund, works similarly in that it holds a basket of investments. But here's the difference. ETFs are traded on the stock market, just like regular stocks. That means you can buy and sell them anytime during trading hours, and their price fluctuates throughout the day. Most ETFs are passively managed. They follow a specific index, like the S&P 500 or NASDAQ 100. That means they try to beat the market. They just try to match it. This results in lower fees, which can make a big difference over time. ETFs are also very transparent. You can usually go online and see exactly what's in the ETF at any time. Some popular examples include SPY, tracks the S&P 500. QQQ tracks the top tech stocks in the NASDAQ VTI, a total U.S. stock market ETF. Are ideal for beginners who want low cost, diversified exposure to markets with the flexibility to trade when they want. Let's compare ETFs versus mutual funds side by side. Feature mutual funds ETFs management, often active, mostly passive. Trading priced once per day, traded like stocks throughout the day. Fees higher, lower minimum investment may require. $500, $3,000, plus often no minimum. Can buy one share, best for retirement plans. Long-term, set a TAN for, CADIT, TATE, low cost, flexible. DIY investors' mutual funds may include sales loads, upfront or back-end fees paid to brokers. Whereas ETFs that alone can save you hundreds, even thousands over time. Fees matter. Let's say you invest $10,000. A mutual fund with a 1% fee costs you $100 every year. An ETF with a 0.05% fee? Just $5. That adds up massively over time, especially when you reinvest those savings. In terms of performance, the data shows that most actively managed mutual funds do not outperform the index over long periods. That's why many investors choose ETFs that simply track the market, and pay less to do so. Then there's tax efficiency. ETFs have a unique structure that allows them to avoid triggering capital gains taxes when investors sell. Mutual funds, on the other hand, often pass capital gains taxes to shareholders, even if you personally didn't sell anything. That's a hidden cost most beginners don't realize, and another reason ETFs are gaining popularity. So which one should you invest in? ETFs or mutual funds? If you're investing through a retirement plan like a 401, you might be limited to mutual funds. That's fine. Just focus on low-fee, index-based options. If you're using a brokerage app like Robinhood, Webull, Vanguard, or Fidelity, ETFs are often the better deal. Lower fees, more flexibility, and better tax treatment. If you want professional management and don't want to pick anything yourself, mutual funds, especially target date funds, can be perfect for automatic long-term investing. But don't feel like you have to choose just one. Many investors use both, depending on their strategy. Here's the bottom line. ETFs and mutual funds are powerful, beginner-friendly investment tools that can help you build wealth safely and effectively. They give you instant diversification, access to a broad range of markets, and remove the guesswork of picking individual stocks. If you're just starting out, the most important thing isn't picking the perfect fund. It's starting now. The earlier you invest, the more time your money has to grow. So here's your challenge. Open your brokerage or retirement app. Search for an ETF or mutual fund. Look at its top holdings, fees, and past performance. And ask yourself, does this match my goals? And if you're still unsure, drop your questions in the comments below. I'll be responding personally. Don't forget to like, subscribe, and hit the bell for more beginner investing tips every week. The stock market, dose and tea, have to be scary. Not when you're rearmed with the right knowledge.